The 1972 crash blueprint is repeating, and 90% of investors don't see it. What if the biggest threat to your retirement isn't a crash, but a slow, grinding stagnation that traps your capital for the next 8 years? Not a dramatic collapse, not a headline panic, but a quiet freeze. Because if you're in your 40s or 50s, losing time is far more dangerous than losing percentage points. And right now, the same structural conditions that devastated intelligent investors in 1972 are quietly rebuilding. Different companies, different technology, same psychology, same concentration, and the same 4 words whispered before every major reset. This time it's different. If that phrase has crossed your mind recently, stay with me. This may save you years. Late 1960s America felt unstoppable. Post-war dominance, manufacturing expansion, suburban growth, the moon landing, global economic leadership. From 1945 to 1970, the U.S. stock market gained over 350%. That's 25 years of almost uninterrupted growth. Confidence turned into certainty. Certainty turned into overconfidence. Investors believed they had solved the equation. They called them one-decision stocks. Buy them, never sell them, hold forever. The Nifty 50.
These weren't speculative startups. They were dominant giants. Coca-Cola, McDonald's, Polaroid, Xerox, cash flow machines, market leaders, seemingly untouchable. The thesis was simple. These companies are so strong valuation doesn't matter. That single belief set the trap. The overall market traded around 15 times earnings. Reasonable. But the favorites? Coca-Cola traded at 46x earnings, McDonald's at 86x, Polaroid at 90x.
Investors were paying decades of growth up front because the story felt safe, because dominance felt permanent, because risk felt invisible. And that's when risk is highest. Then came 1973, 1974. Oil prices quadrupled. Inflation surged above 11%. Interest rates spiked. Unemployment doubled. The broader market fell roughly 50%. But the Nifty 50? Some stocks dropped 70%. Some 80%, some over 90%. And here's the part most investors forget. It took 8 years to recover. 8. If you were 45 in 1972, you were 53 before breaking even. That's not volatility. That's retirement compression. That's optionality disappearing. Fast forward. Today we have 7 companies dominating the index. Microsoft, Apple, Amazon, Meta Platforms, Alphabet Inc., Nvidia, Tesla. 7 companies now represent roughly a third of the S&P 500. If you own index funds, you are heavily concentrated. You just don't feel it. Because concentration feels efficient in a bull market. It feels intelligent. It feels validated. Until growth slows. And here's the key distinction. Crashes force action. Stagnation traps you quietly. If these companies simply underperform for 5 to 8 years, index funds don't implode. They flatten. And flat returns in your 40s or 50s are far more dangerous than a sharp drop in your 20s. Time becomes the casualty. At this stage of life, wealth isn't about maximizing upside. It's about eliminating fragility. Fragility is when one system determines your outcome. Optionality is when multiple systems generate outcomes. Right now, most investors are diversified across stocks, but not across systems. That's the difference. Think of wealth in 4 quadrants: public equities, private cash flow assets, scalable digital assets, tax-advantaged structures. Most portfolios live almost entirely in quadrant 1. That's concentration disguised as diversification. Sophisticated allocators reduce dependency on a single engine. They build parallel income systems. One of the most interesting uncorrelated models today is digital media asset ownership. Not influencing, not filming your lifestyle, asset ownership. Faceless YouTube channels built as scalable revenue properties. They generate global advertising income. They operate independently of stock market multiples. They can be systemized. They can be outsourced. And importantly, they can be sold. That last point matters. Sellable assets create liquidity. Liquidity creates flexibility. I didn't take this model seriously at first. It sounded like internet noise, so I evaluated it like an investor. Scalability, capital requirements, margins, operational leverage, risk exposure. What surprised me was the structure behind it. One of the most systematic frameworks I analyzed was built by Matt Parr through his Tube Mastery program. What stood out wasn't hype, it was process. Data-driven niche validation, outsourced production systems, monetization frameworks, an asset-first mindset. This isn't about becoming a personality, it's about building media equity. For someone in their 40s or 50s with capital, this isn't an all-in move, it's a strategic allocation. Even 5 to 10% of deployable capital into a scalable digital income engine can reduce equity dependency, create independent cash flow, increase reinvestment capacity, provide optional liquidity. That's portfolio construction, not side hustle thinking. History teaches one consistent lesson. Repositioning is cheapest before it feels urgent. When the Nifty 50 peaked, nobody felt urgency. By the time urgency appeared, adaptation was expensive. If markets stall and investors rush toward alternative income systems, competition increases, costs increase, entry barriers rise. Optionality is most affordable before it's obvious. If equities underperform for the next 5 years, would you rather be fully dependent or strategically diversified across systems? At this stage of life, resilience beats prediction. Optionality beats optimism. Intelligent investors reposition before the crowd does. If you're serious about reducing dependency on a single market cycle, the structured digital asset framework I researched is linked below. Evaluate it now. While you still have leverage, study it like any serious capital allocation decision. Because the greatest risk isn't volatility. It's discovering too late that your portfolio was more concentrated than you thought. History doesn't repeat, but it rhymes. And right now, the rhyme is getting louder. The only question is whether you adjust or repeat it. If you enjoyed this video, please subscribe to the channel, share it with others, and let us know your feedback in the comments.